Stephanie Zimberg, representing Police Commissioner Sewell.
Ed Berman, here by invitation.
Allison Hirsch, representing Controller Brad Lander.
John Dorsa, alternate designee for Controller Brad Lander.
Could you hear me? Because I can't hear anything.
It says that we're not joined to the audio.
No, she's not on that one.
Yeah,
You dialed in?
Yeah, can you hear us now?
I sound checked before.
Sound like a
Can
variety.
you hear us or no?
Can anyone on the call hear us?
We can hear you.
I can hear you.
Oh, so it's Yaffa.
Can you hear me now?
Yeah.
Could you hear me? Okay,
You hear
great.
us?
Now I do.
All right,
You
we'll
want
start
us
from
to
the
start
beginning.
over?
Yeah, I didn't hear a thing.
Stephanie Zimberg, representing Police Commissioner Sewell.
Ed Berman, here by invitation.
Allison Hirsch, representing Controller Brad Lander.
John Dorsa, alternate designee for Controller Brad Lander.
I'm Steve Meyer. I'm here by invitation.
Rob Appling, Wilshire, by invitation of the trustees.
Joe Alejandro, PBA. Chris McGrath, PBA by invitation. Thomas Gilmore for PBA.
Nicole Chambrisi, Police Pension Fund, present by invitation of the fund.
Johnny Ramirez from the CEA with the proxy of the DEA, SBA, LBA.
Andy Vincent Miller, Police Pension Fund, present by invitation.
Bob Sansky, State Pension Fund, present by invitation. Kevin Holloran, Pension Fund, present by invitation.
John Mercerberg, Controller's Office, present by invitation. Mitch Fielding, Comptroller's Office, present by invitation.
Heidi Sue, Controller's Office, here by invitation.
Dylan Herman, Axia, here by invitation.
Okay, Commissioner of Finance.
Javon Ray, representing Commissioner Nightlight.
Mr. Cop. Mayor.
Bill Dukes for the mayor's office.
Actuary.
Marek Tuskevich for the Office of the Actuary.
Did he get sworn in finally?
Law Department. Anyone from the Law Department?
I don't think they're on.
You don't see him on there?
Okay, with that,
I thank you, Kevin. I just want to ask, Marek, were you sworn in yet?
I am not sworn in yet. We're waiting for a BERS resolution and for me to establish residency next week.
Okay, very good. I'm very happy to hear that anyway.
Yep. I'm good to be here, and I am, I guess I'm on the payroll. I'm on the Office of the Actuary's Deputy Chief Actuary.
That's what counts, the payroll. There you go. Very good, Marek. All right.
Thank you.
Well, congratulations, your first police pension meeting now. So, very good. So I want to begin. I want to say, everybody, I hope you had a good summer. I hope you were able to dodge criminality out there and it was all good. Thank you. So I'm going to turn it over to John Dorsa, who's going to lead us through the agenda. So thank you, Joe. Welcome back, everybody. I hope everybody had a wonderful summer, and school's about to start. So, let's get excited for a happy school year. And with that said, we've already mentioned that's the first meeting for the soon-to-be chief actuary, soon-to-be officially chief actuary. But we also have today the first meeting for the CIO, who has also been sworn in, has already taken his oath of office.
I wasn't going to assume it was his first meeting.
It is his first.
Wow, very good.
So we're going to turn it over to.
Might be your last. I'm not. I've been there before, unfortunately, when we had a CIO one meeting and what we've got.
You know exactly. There you go. So with that said, I'm going to turn it over to Steve. He's going to walk us through the quarterlies, and then you'll hear from Ed Berman, who's just a risk presentation. And then we also have in public session a review of the new website tool that's going to be done by Kate Visconti from Pensions. So I think it's a pretty interesting public agenda, and then we'll go into executive agenda to discuss more specific items related to the fund. So with that, Steve, welcome, and we'll turn it over to you.
Terrific. Great. Thank you, John. And thanks for having me here, everyone. Good morning. It is a privilege and honor to present to you today. I was hoping this is the first of many such presentations, but given Joe's remarks, I'm not so sure now. I'm going to continue to provide market updates and provide some context in terms of how the markets and how economic developments are impacting your investments. But I'm going to do so with a few recurring themes, and those are listed. Actually, Kate, could you go ahead one slide, please? Those include investing for long-term outcomes, obvious, right? Diversification of our investments, the need to review the world through a global lens, and lastly, investing consistently over time. The next slide is actually an article I saw in the Wall Street Journal a little over 2 years ago, and I thought this was fascinating, but it really drives home the idea that the pension obligations of police and other pension funds are actually really long-tailed. This one happened to have been 155 years, and that there was a descendant of a Civil War veteran who fought for, ironically, both the South and then the North, survived and lived until the ripe old age of 92.
They had better benefits for the North, that's why.
Well, yeah.
There you go.
What was interesting too, Joe, is that back then, people that had a stable income were actually really quite in demand by other people. So it was not uncommon for Civil War veterans to be sought after by women.
Especially the older guys.
Well, they needed the care, but they had the money.
Yes.
So this gentleman actually fathered this woman, Irene Triplett, at the ripe old age of 83. And she lived until she was over 90. Again, so she apparently had gotten a $73+ payment a month. But again, I think it really drives home the fact that, you and we collectively are long-term investors, and we need to always keep our eye on that. The next slide is actually one of my favorite slides. I've loved these slides for many years. Yeah. It's actually Callan and Associates periodic table of investment returns. And it demonstrates that we really never know which asset class is going to wind up on top. And drives home the need to diversify our holdings consistently over time across assets as well as strategies. And I'm hoping to present to you at some point a similar slide that talks about the difference in returns over the private assets as well in future meetings. I think one other thing is very interesting about this slide, and I suspect it's already jumped out, is that upper left-hand side of the slide where you can see emerging market, significant outperformance for a 5-year period from 2003 to 2007. Which is kind of unusual. And if you think back, that was actually the BRICS, Brazil, Russia, India, China, and South Africa, and the lead up to the Beijing Olympics in 2008. So obviously you had 5 great years, a terrible down year in 2008, and then a 78% rebound in 2009. So it underscores the fact that there's some benefit for having themes in your investments, if you can figure out what they'll be beforehand. But again, diversification should drive our
A little bit of history. Because of that period, there was a first deputy controller that was put on the watch list because of that.
Was it the CIO?
Yeah, no, it wasn't the CIO. It was the first deputy controller who got put on the watch list.
Former. I mean,
yes. It was not a happy day.
Next slide, Kate, please. This slide is actually, I believe it's from the United Nations building here in New York. It not only does your plan invest in global assets or U.S. and non-U.S. assets in both the public and private space, but our domestic market is impacted by things that occur outside of our national borders, including technological innovations, monetary policy shifts across central banks around the world, currency valuations and the impact on trade balances and competitiveness of countries, geopolitical developments, including elections, wars, alliances, trade pacts, and even, not to politicize it, but pandemics, climate change, and the international response that we've seen around the world to address those concerns. And really what it drives home is that the U.S. is not an island, but part of an integrated world economy. This next slide, I believe you saw the last time the BAM presented, and this slide had a different title back then. I believe it had the periods of lost decades. I actually think this slide serves a good purpose, showing some other things as well. So if we don't have a crystal ball to forecast returns, as long-term investors, we can benefit from these market developments. And if you look at the slide, there's a general gradual increase in valuations of the 60/40 portfolio from 1900 on to current day, and moving up into the right-hand side. And again, it drives home that we should not try to ever time the markets, but it's really what's going to drive our performance is time in the markets, and being able to consistently benefit from those technology developments and innovations around the world, the growth of the world economy, the globalization and immigration trends, labor productivity growth and improvement in global education, and finally, increased standards of living around the world. Moving to the next slide. This is really the meat of our economic and markets update. Inflation obviously is top of mind these days, both here and outside of the United States. Our economy is emerging from a global pandemic and undergoing major transitions and suffering from post-pandemic headwinds. The increase in demand for goods, services, and experience is significant, while supply still lags, which has helped push prices higher. We've also seen shifting from unprecedented easy monetary conditions or monetary policy and robust fiscal spending to significantly tighter policies, certainly here and abroad as well. And we're still seeing continued supply chain disruptions impacting the markets and pushing the price of certain goods higher. An example of this is China's zero-tolerance COVID policy. And I don't know if you saw in the press last week, they closed their fourth largest city again. There are 21 million people in that city with significant manufacturing as well, which again will exacerbate that problem of disrupting the supply chain. We've also seen labor shortages pushing wages and input costs higher generally. We've potentially seen a peak in globalization trends, which means there may be a less availability to Asian and Eastern European and Latin American lower cost workers. And finally, higher energy prices and commodity prices. And a lot of that's driven, at least initially, by Russia's invasion of Ukraine and very focused on oil. Shifting to the next slide, again, we've experienced this recent inflation spikes both here and abroad, and now inflation levels are at 40-plus year highs. This chart shows on the left-hand side June's PCE measure in the States, that's Fed's preferred measure at 6.8%. The Eurozone in July was at 9.1% CPI inflation. In the UK, July at 10.1%. So really significant increases in inflation that are being addressed by central banks. These outcomes, I should remind everyone, are certainly in excess of the Fed's and the ECB's and the Bank of England's expressed 2% inflation target. And it spans other economies as well. Spain's up over 10%, Germany inflation's over 8.5%, France over 8%, Canada over 8%, and Australia over 6% as well, and raising rates to address those concerns. The next slide is actually a recent University of Michigan survey indicates that inflation expectations, again, it's a survey, not actual, exceed 5%, the highest they've been in 15 years, or I should say near the highest they've been in 15 years. And the Fed's concern is that the longer inflation remains elevated, the more likely it becomes embedded in expectations. Again, a real problem for the Fed, and would place consistent upward pressure on wages, cost of goods, and services. But there is some good news on the upper right-hand side of that slide. You can see that we're slightly off the peak in inflation expectations, again, given this survey. So perhaps we have seen the peak in inflation, although I wouldn't bet that just yet. The next slide rather, higher energy prices has certainly been one real cause for the year's spike in inflation. This slide looks at West Texas Intermediate crude oil spot rates over the last 10 years. Russia's invasion of Ukraine has certainly exacerbated the energy price pressures in Europe and abroad, and particularly in Europe. I don't know if you saw the news over the weekend or today. The current energy situation with them closing down Nord Pipeline 1 for liquid natural gas is really causing the Europeans and the Brits to rethink their energy strategies and try to retool their energy networks very quickly. This 10-year chart, again, represents West Texas Intermediate crude, so it's really reflective of the price pressures in oil here at home. And prices are still much higher than pre-pandemic levels, even though they've come down. At one point earlier this year, they were over $120 a barrel of oil, and WTI traded out last week at 88 and change per barrel. So it's come off the boil, but it's still significantly higher than it had been pre-pandemic. The next slide, in July, unemployment was at a 50-year low in the United States at just 3.5%. In August, unemployment actually moved slightly higher to 3.7% as more people entered the domestic labor market. Unemployment actually rose despite the fact that our economy actually produced another 315,000 jobs in the month of August, slightly above expectations. The participation rate is now at 62.4%. Pre-pandemic, it was at 63.4%. In an economy and a workforce our size, that's material. Despite improvements in the participation rate, we're still down over 2 million workers that have left our economy. And the shortage of
To
workers.
do that, you'll need to be online.
I don't know why they did that. I'm sorry about that.
That's all right, Joe. The shortage of workers is certainly putting upward pressure on wages, and employers have struggled to attract, retain, and adequately compensate workers. The next slide is a further reflection of the unemployment of the labor market trends in the states, again indicating the shortage of workers in our economy. Since the pandemic, the U.S. has seen what's referred to as 2.1 million excess retirements, meaning retirements above what we traditionally had been expected pre-pandemic. These are due to demographic changes such as retirement. There's also low birth rates in the states that are driving the available wage force lower, as well as lower immigration into our country, all contributing to this material labor shortage. And I don't know if anyone reads Barron's over the weekend, but there was a primary article that really talked about the fact that this is going to get worse and will probably be consistent for some time, given those trends that have been exacerbated by COVID. On the next slide, this chart shows 30 years of what is called the misery index, which is basically the CPI inflation plus the unemployment rate. Today it stands at just over 12, which is nearly 50% higher than the 30-year average of just over 8. And this is all despite the fact that we are just off a 50-year low in unemployment. So it really indicates how much pressure inflation has put on the average citizenry throughout the United States. As a point of history, the lowest misery index was actually achieved by President Dwight Eisenhower in 1953 at just 2.97. The highest delivered by President Jimmy Carter in 1980 at 19.72. And to give you a little international flavor, the misery index in Venezuela in 2020 was actually 3,827. Obviously, they were experiencing not just high unemployment, but hyperinflation. Next slide, please. This 10-year chart really reflects regional economic growth patterns and shows the disruption that the COVID pandemic has created on global economies. Spikes down at the start were pretty consistent across those 5 major economies, the US, the Eurozone, UK, Japan, and China. And the recoveries have been a little more diverse or diffused based on differences in policy responses across the regions. I think the other thing that's interesting about this slide is that top blue line is slightly below 10%, around 8 or 8.5%. And that's China's GDP growth, which has been consistently 8 to 8.5%, and has been a real engine for global growth. And you can see that now flat lines. It's about flat at 0 right now, given the fact that they're still wrestling with their zero COVID tolerance to COVID policies and having their domestic economy and the rest of the world impacted. Next slide. Despite 2 consecutive quarters of negative GDP growth on the far right-hand side, you can see the first and second quarters of this year, we saw a contraction in U.S. GDP, down 1.6% in the first quarter, down 0.6% in the second quarter. And again, despite these occurrences, and the rule of thumb typically is 2 consecutive quarters of negative GDP growth equal a recession, it's very likely that we're not in a recession right now. Our labor market is simply too strong, again, coming up that 50-year low in unemployment, and the consumer still remains robust and well-positioned from a balance sheet perspective to continue spending. The National Bureau of Economic Research is actually assessing our economic status and is looking for a broad contraction of our economy. And they'll report actually when the recession, if one occurs, actually did in fact occur. I think what's also interesting here is you can see that we saw contraction in both net exports in the first quarter, and the second quarter saw drawdowns in good inventories, as well as a slowdown in housing activity. But the light gray bars, they're consistently fairly robust, indicating consumers continue to spend money and fuel growth. The next slide, let's shift over to monetary policy and see, review the Fed's, what's referred to as the dual mandate. This is actually language that was approved by Congress, congressional legislation in 1977, and it tasks the Federal Reserve with achieving maximum employment, stable prices, and moderate long-term interest rates. And in my mind, that's actually a tri-mandate versus a dual mandate, but the market basically considers the fact that if they can assume stable prices, that the Fed will be promoting moderate long-term interest rates. So that mandate is now the dual mandate of a maximum employment and stable prices. The first priority stated by Fed Chair Powell recently is resolved to reduce inflation to its 2% target, even if it results in an increase in unemployment. The first priority is to decrease inflation to eventually promote stronger real wages, those are adjusted for inflation, and an unemployment recovery for the future. Fed Chair Powell has also reflected recently at the Jackson Hole, Wyoming Symposium that fighting inflation will bring some pain to households and businesses by slowing the economic growth to below trend and causing some softening in the labor market. There's all sorts of discussions now about, will the Fed be able to achieve a soft landing? That's a pretty big ask given the fact that they've been pretty aggressive in raising rates and they are pretty far behind in fighting inflation. Typically, if the Fed's activity does push us into a recession, you'll see a minimum of a 2% increase in unemployment. Again, that's the pain that Chair Powell was referring to. Next slide. The top chart of this slide, I actually love this slide. It actually looks at 30 years of official Fed funds rate changes. And it's, as a side note, since 1983, which is 39 years, the Fed has actually increased rates 86 times. 75 of those hikes have been below 50 basis points, meaning normally 25 basis points. So this year's activities, the rate hikes that started in March with just 25, but were followed by a 50 and 275 basis point hikes, is actually highly unusual and is reflective of the fact that inflation is elevated and the Fed is behind the curve in addressing it. The market today is also pricing in another 75 basis points of rate hikes for September 21st, followed by another 50 basis points in November, and finishing out the year with 25 basis points in December. Again, those are expectations as it stands today. If these are actually realized.
Is that in line with the rest of the world? Those kind of hikes? The Euro Central Bank and I'm just trying to figure out.
So that's a great question. So the ECB actually meets on Thursday and the market is pricing a 75 basis point hike.
So they're acting in unison.
Yeah, they're trying to catch up. They're further behind because they're coming off of a base where they had negative interest rates, negative official rates that they've gotten flat. But again, I think there is a real need for them to raise rates given, again, those charts we saw earlier, the inflation throughout the Eurozone is over 9%, and it's going higher given the inflation, the pressures on.
And they buy gas and liters.
Yeah, and they tax them heavily as well. One or two other things that we do expect to see at the end of the year, Fed funds are probably in the 3.75 to 4% range. The current thinking is that that's probably close to the terminal rate of 4 to 4.25. But again, it's going to be dependent upon the economic developments that Chair Powell and his colleagues are looking at. One additional note: Fed Chair Volcker actually hiked rates to 20%. Again, in 1980, after 15 years of failed attempts to lower persistent inflation. They kept raising rates and they would loosen them too quickly and inflation would come back too fast. So Fed Chair Powell is very aware of that circumstances and he's very committed to avoiding that same policy. On the next slide, higher U.S. Official interest rates and tightening financial conditions are pushing the yield curves higher. On the left-hand side, you can see, obviously, it's been a very difficult environment for long-term, high-duration bonds as well as growth-oriented stocks. The current yield curve is inverted, as you can see on the far right-hand side, which means that the short-term rates are actually higher than the long-term rates, and that inversion goes out to 7 years at this point. And this may be due to a few reasons. The Fed is persistently tightening and has communicated their willingness and ability to continue to do so. But also the market may be expecting over a longer period of time more return to normalcy, which is why the 10 years haven't pushed up quite as dramatically, as well as the fact that the market may be discounting the Fed will be successful in containing inflation. Inversion of the 2s, 10s, again, that slide to the right, it's come in significantly. It was as wide as 35 basis points. I think it's 22 basis points this morning. And that's a reflection, I think, more of the 10 years backing up further in yield today. As of the time of this analysis, however, we've seen 10-year yields move 160 basis points higher year to date, which is really quite substantial. On the next slide, this is a look at our corporate credit spreads or in the corporate bond sector. This looks at investment grade corporate spreads on the lower part of the slide in orange, and high yield spreads higher on the slide in blue. Investment grade spreads are now near about 140 over similar maturity U.S. Treasuries, and high yield is about 450 basis points over. So it's come off the boil a little bit from where it had been in the second quarter, at closer to 600. And again, we'll see where it goes. If a recession does occur and it's anything beyond mild, you can see those spreads widen out significantly. It's also important to note that the returns in investment grade have actually underperformed high yield because the duration in the indices typically is about 2 times what it is in high yield. High yield has a higher coupon, traditionally slightly lower maturities, and that pulls down the duration, which means that they're less sensitive to interest rate changes. On the next slide, Kate. Again, the pain associated with tighter monetary policy and conditions is global. And this slide actually looks at the 10-year sovereign yields across major nations. You can see on the right-hand side of that slide, with the U.S. up top, I think that's field number 10, our 10-year Treasury yields have actually widened out 161 basis points since the beginning of the year. And you can look down and see that, so for example, Italy is 264 basis points wider, and all manner of sovereign debt is significantly wider, with one exception, and that being China. China actually cut rates in August to address issues in their local economy. They've had issues, obviously, with lockdowns, supply chain issues, manufacturing issues, and also concerns about the viability of the property markets there. So they are an outlier. On the next slide, the U.S. dollar has been incredibly strong and strengthening this year, and that's due to a few factors. Firstly, higher interest rates or interest rate differentials in the States. And those are both short official rates as well as long-term rates with the backup we saw in 10s. We also in the U.S. enjoy our currency having reserve currency status, and that there are several sectors of the global economy that are still priced in U.S. dollars, primarily oil. We've also benefited from flight to quality buying of U.S. dollars, given the geopolitical risks that have increased. And there you look at Russia and China saber rattling in the Straits of Taiwan. So the impacts of the U.S. dollar strength are a few. Firstly, it actually lowers U.S. dollar denominated earnings that U.S. companies receive from their operations abroad, which is a little bit of a headwind for earnings. It also lowers the attractiveness and competitiveness of our goods that are sold outside the States, given the fact that they wind up feeling and actually being more expensive in foreign countries denominated in other currencies. And lastly, they serve to lower inflation. The strong dollar actually decreases the price of our imports, which helps to dampen inflation, which is something that the Fed feels is positive. There are concerns today on whether the U.S. dollar strength is actually causing additional stress in the global financial system. And if you look at the next slide, these are 3 primary trading partners and currency pairs: the euro versus dollar, the pound sterling versus dollar, and the U.S. dollar versus the Japanese yen. These are all at multi-decade lows, or meaning that the U.S. dollar is at multi-decade high. Versus the euro, it's now trading. The euro now buys only 98 cents versus it had purchased over $1.50 over the past 10, 20 years. The pound sterling is about 115 today at an all 20-year low. And the U.S. dollar buys fully 136 yen now, up substantially for where it had been in, say, 2012 in the 80s. The next slide really kind of starting to get more into the meat of what we're seeing in investments. The volatility in stocks and bonds obviously has increased significantly year to date, and certainly in the first and second quarter of this year. On the left-hand side, we have the VIX, which is derived from S&P 500 index options pricing. This is referred to as Wall Street's Fear Index. It is now over 25 today, and the 30-year average is about 19. And there's a saying in the marketplace, when the VIX is high, it's time to buy, meaning when there's fear and uncertainty in the market, it's a better time to be buying. And then when the VIX is low, it's time to go. those are pithy little statements, but they're worth thinking about, in the context of how we go through our rebalancing process. On the right-hand side, this is a similar type of slide. It's called the MOVE Index. It's the Merrill Lynch Options Volatility Estimate. It actually measures the U.S. interest rate implied volatility in over-the-counter Treasury options markets. It looks at 2 years, 5 years, 10 years, and 30s. It double weights 10. And again, it reflects the fact that on the far right-hand side of that chart, you can see the volatility has picked up substantially as well. Higher volatility indicates more risk and uncertainty in the markets, and to the point earlier, perhaps more opportunity as well. On the next slide, again, getting more into the meat of investments, for 20 years, the equities, both U.S. and non-U.S., have had price appreciation has dominated. On the left-hand slide, you can see those are the quarterly returns for the S&P 500 large cap, for the MSCI EAFE ex-US, and for the Russell 3000. And notice the thickness of the band between 0 and 10%, where, again, those returns are clustered. And that shows that over time, an investor throughout cycles will benefit from being in the markets. On the far right-hand side, you can see that we've had 2 quarters, the first and second quarter of 2022, where all 3 of those measures have been below 0, indicating negative returns. On the right-hand side, this is the Bloomberg Barclays aggregate annualized returns, which shows 2022 being remarkably negative. The U.S. Ag has had its worst first half performance since 1976, down 10.3%. The U.S. 10-year U.S. Treasuries have had their worst first half performance, get this, since 1788. And there wasn't even a U.S. Treasury then, so they must be using proxy, probably New York State bonds.
Congressional script.
Maybe it's down 9.1%. Over the past 30 years, the U.S. Ag has produced positive returns in 26 of those years, the best being up 18%, the worst being down just 3%. Year to date, 2022, it's down 10%. So again, it's noteworthy of how negative the performance in the bonds have been this year. They've had bonds have had significant sell-off following 30 plus years of secular decline in interest rates, and as well as incredibly easy financial conditions through the pandemic, through both official rates being artificially low, as well as quantitative easing and the expansion of the Fed's balance sheet to record levels. On the next slide, I have to credit my colleague Neil Messing with this slide. This actually shows, really, it does a very good job of showing the full fiscal year of 2022, which is the second half of 2021 and the first half of 2022 calendar year. And if you look to the far left, things had been going pretty well with the exception of emerging market debt. Again, COVID response was slower and reflected in the price of those shares. But the rest of the markets were doing quite well with the slight exception of the ag. The performance, however, for the second half of the fiscal year, or the first half of calendar year 2022, was quite abysmal. And you can see that certainly had pulled down the overall performance for the full fiscal year on the far right. And I think Neil also threw in here the outperformance of the really strong returns of WTI crude prices for the full fiscal year, up almost 44%, to underscore the impact of higher energy prices. The next slide is actually, this slide punctuates a few things for me. It shows the relative outperformance of U.S. stocks on a cumulative basis relative to developed market equities, ex-U.S., and emerging market strategies. And on the far left, you can see that dark line up top, that's the cumulative returns for U.S. dollars relative to, again, developed ex-U.S. and emerging markets, which haven't done nearly as well, although they've all been off recently given the sell-off in the early part of 2022. The reasons for this outperformance, I guess, is anyone's guess. I'd suggest it's probably because we had a more robust response to the pandemic here in the States, that we had a faster recovery that followed through post-global financial crisis. The fact that in the developed market, ex-US may have been also pulled down and impacted by Brexit, as well as the China slowdown we've seen more recently. I'd say also monetary policy differentials and market liquidity concerns as well. In the center of that slide, you can see that irrespective of how it's gone for the last 10 years, it's been a challenge for the fiscal year 2022 for all manner of stock. And I know John's with us, and John Mercerberg is going to actually go through this in more detail in a few moments. And on the far right-hand side, you can see the fiscal year to date 2023, really July and August, we've had some improvement. You can call it a bear market rally. I'll leave it up to John to tell me what he thinks of that. But then a corresponding sell-off in the latter part of August after Powell's remarks. Moving ahead a couple of slides, Kate. Talking more about performance. As indicated earlier, the public market assets and investments were under significant price pressures in 2022 for the full fiscal year. More importantly, the second half of the fiscal year 2022. As a result, performance across all public markets was negative for both the full year as well as the second quarter. The good news is the 5-year cumulative returns to the right of that chart were actually all positive, although all but the U.S. equities have met or exceeded the 10-year average expected returns. Those expected returns are put out in connection with our consultants, and in fairness, those are 10-year returns, not 5. So certainly there's time for these markets to catch up and for those numbers to be achieved again over time. Next slide. This is actually the police plan's net public market returns by strategy. And as presented, again, 2022 has been a very challenging year for all investment categories. We saw a negative second quarter performance pull down the full fiscal year 22's results. And as I mentioned, John Mercerberg is going to speak more on that in a few moments. Fixed income returns were actually more correlated than they traditionally are with equities. Certainly we've seen a significant backup in yield. And unfortunately, our fixed income holdings have offered very little short-term diversification benefits. However, for the 5 years, all the returns were positive. The next slide, and perhaps tells a better story because of a different asset class, our net private manager returns by strategy and plan have been quite strong for the fiscal year 2022. And in the upper chart under the 1 year, you can see that they've been positive in all areas and very positive and substantial in most. Our hedge funds have delivered a positive return as well as our opportunistic fixed income. And those are both mark to market through June 30. So those are current market prices for June 30. Private equity, core and non-core real estate and infrastructure are actually priced with a 1 quarter delay. But as you can see here, the returns have been very substantial and strong at 29% for private equity, 33% for core real estate as real estate continues to improve following the pandemic, and non-core opportunistic up 30% as well. On the lower part of the chart, you can see that the police pension plan actually performed for the full year, delivering a negative return, which isn't always comforting, but a negative 7.2%. It did, however, outperform its policy target returns of negative 8.8%. So although it doesn't seem as satisfying, it still is outperformance and noteworthy. On the following slide, we look at a breakdown of the outperformance for the second quarter or the fourth quarter fiscal year 2022. And again, you can see that we delivered in the police pension plan a negative 8.6 versus a negative 10.07. Again, those excess returns of 147 basis points were broken down. 35 basis points of that was due to the asset allocation effect, where we weren't perfectly on target for various reasons of the target portfolio. And the other 112 basis points of return is really through investment manager alpha or investment manager selection. Again, those were all both positive. On the next slide, we look at our public market excess returns and basis points. And there's interesting things here. And again, I'll leave it to John to talk more about the equity portion of your portfolio. On the fixed income side, we've actually performed pretty consistently. We've underperformed our custom index a little bit, only because it has a slightly higher duration, targeting 8% versus the ag at 6.8% these days. Convertible bonds have actually outperformed. Our convertible bond strategies are customized. They tend to be more bond-like, a little less equity-like, and considered more defensive. And as equities have sold off, and you read into that, Tesla has sold off, we've seen the outperformance in certainly the quarter, but also the full fiscal year at over 1,100 basis points. On the next slide, again, another look at our private market excess returns and basis points for the second quarter, and they are significant. My colleague Dan Haas is included in the benchmarks, so you can get a sense for what we're benchmarking these return streams against. But as you can see, that the outperformance has been substantial, certainly in 1 year, and consistently strong out 10 years, again, focusing on the long term. As I mentioned earlier, private equity, real estate, infrastructure are really marked to model at this point, not necessarily market prices. They don't turn over and trade like stocks and bonds. The private equity, I think Anash has mentioned that the marks through June seem to be in the magnitude of about 3.3% for 70% of those reported, so slightly down, but again, nothing near the way in terms of the public markets. Real estate, we've seen low single-digit returns or marks, and again, that's reflective of the continued recovery in core and non-core real estate. And in infrastructure, it's flattished up a little bit in that those markets continue to perform well with the digitization, digital infrastructure being built up.
So can I ask a question?
Sure, John.
So if going forward, since we're in this period of uncertainty and while we're not in a recession yet, from your earlier comments, we might be heading towards that going forward. How does that 1 year, do we expect that trend to continue where, you know, private equity's still in double-digit returns and, you know, and hedge funds is you know, somewhere in the 4.6 range? Do you expect that, you know, hedge funds working against the market that would be a place where we might see some alpha that we weren't expecting? And do we expect that if the private markets will be kind of hit with a whipsaw, rates go up and, you know, and we do find ourselves in a recession?
Those are all good questions. So let's talk about hedge funds first. I mean, certainly hedge funds can take alternative views. They can be global macro, they can be long short equity. And I'll leave it to Neil actually to go into more detail if he's on the line in terms of his expectations. But generally, those tend to have some value in terms of risk mitigation, and they don't and benefits of correlation by not being correlated to equities. In terms of the impact on the private markets associated with a recession, and I don't mean to be flippant, John, but it's anyone's guess. The expectation is we've seen price earnings ratios contract in the public space. We're probably going to see an EBITDA contraction as well in private equity. The activity in buyouts and M&A has actually come down significantly. I think there's still $1 trillion of dry powder, and the level of deal flow this year to date has been much lower. And I would expect that two things. Firstly, that if we are in a recession, that will impact pricing in a negative way, but it also provides opportunity as we continue to deploy new capital into the space, and we have commitments we've already been made that the capital hasn't been called yet. So again, the issue with, you don't really want to try to time the private markets. You don't lean in and lead out. You want to be consistent and, you know, adhere to your pacing plan. It really looks at what's going on over 5 years.
Am I wrong though in private markets, in particular private equity? You're not going to see the return, obviously, from this year. Those returns are actually baked in from the class that they had bought in like 7, 8, 10 years ago, until they sell those assets, right? And they close out those funds. You're not going to see that return. So what you're buying today, you're hopefully buying low, and then you'll make a lot of money down the road. But I mean, I don't know how many opportunities there are for that right now. But nobody wants to cut their throat either.
Yeah.
You know?
That's a very good point. And again, it's vintage year driven.
Vintage year, right?
But the private equity firms, they can also be more patient. They don't need to sell if the market's up. They can wait until things recover. They can wait for better opportunities. They can deploy. You probably want to be deploying capital when people are more fearful and volatility.
They'll raise a lot of money now, right? Yeah. They'll go around raising money because they want to have the money for that opportunity when they get it. But
a little bit of headwind there, Joe, to be candid. You're right, they should be raising money now when it's better investment. But, you know, institutional investors typically may pull back a little bit. If they're fully allocated to private equity and the stocks of the public market go down and they tend to feel like they're overweight, I know
That's
that
our
there's-
problem. We have, a real investor would say, now's the time to buy when it's low, right? But we can't do that, like, you know, essentially. You know, an average.
Well, you start worrying about the
Investment
denominator effect.
Yeah, right. We have to worry about the basket.
Guys, hold on. Yeah, so on the record of this, you gotta talk one at a time.
Yeah, we have too many things to worry about here and legal paradigm that we operate under in order to do what we'd like to do, which is buy low and sell high, right? We can't do that, so.
Joe, if it's all right, can I invite Anash to make comments around private equity? And he is really quite expert. Anash, you on the line?
Yeah, I'm here, and Steve, I think you hit on most of the points.
I got them from you, Anash.
The one thing that I would add is historically, and I don't know why my video just went off, historically, private equity has outperformed public equities in periods where the market is coming down, and in periods of recession, in periods of public equity underperformance. We'll see what happens in this environment, because this is a very different environment in that we haven't seen inflation this high for decades, and we haven't really seen rising interest rates at this magnitude for some time. But I think the trustees should take comfort in the fact that we do have a very diversified portfolio in private equity. A lot of managers that are diversified by strategy and also by geography. And Joe, to your point, we have made a number of commitments in the last couple of years where those funds that you recently committed to are going to be buying over the next couple of years and should find some good, attractive buying opportunities.
Very nice. Thank you. Terrific. Kate, the next slide, and I think I'm almost ready to turn over to Ed to talk about risk. The next slide is actually a summary of our rebalance activity in the second quarter of calendar year 2022, fourth quarter of fiscal year 22. We completed contracting with 2 mid-cap equity managers, which were funded during the quarter. To fund those new mandates, we sold out of our BlackRock Large Cap Russell 1000 portfolio and then reallocated that's a mid-cap, as well as the large cap top 200. Again, we wanted to make sure that we kept the portfolio equity holdings market cap neutral. On the next slide, it actually looks at our under and overweights, and I'm happy to report that they're all certainly within tolerance, well within tolerance. We have a robust process and a disciplined process around rebalancing. The asset allocation that you give us is actually the roadmap for us, the rules of engagement that flow into the investment policy statement. So, we don't want to second guess those decisions, and we want to make sure that we can get as close to those target levels consistently as possible, adjusting maybe for transaction costs. But as you can see, it's all within, for the most part, 1%. I think the high is 1.1% over, with the exception of cash, which it has a zero policy target, but there always is some need for more tactical use of cash to meet both payments, pension benefits, as well as capital calls. And with that, I'm going to turn over to Ed to take us through his risk management quarterly review, unless there are any questions. And I should have said this up front, but I should have, from now on, there's no such thing as a bad question, and I prefer to be interrupted.
Oh, we could come up with some bad questions.
You're going to regret that.
Yeah, you're going to regret that. But I also have to caveat that there may be some bad answers, so I apologize in advance.
I always say that there's no bad questions, just you may not like the answers, that's all.
Sorry, Ed, please.
Thank you, and thank you, everybody. I'm excited to be here. It's my first time, obviously, reporting to the board. And we use this as an opportunity to refresh the presentation. You notice the new layout. Can we have the next slide, please? It's a new layout and slide expense. It's used And first, I'd like to thank the risk team for working really hard to bring together this, analysis, and specifically Dan Pass, so I'm sure you met him a number of times before. Dan is offline right now, ready to step in, correct any mistakes I can make. So let's dive straight into it. So the risk for this quarter, you can see at the bottom right of this table was 12.4%, about a 1% increase from the previous quarter. Just to remind what this number means is that the expected returns for the plan for the next 12 months will be within plus minus 12.4% range. There's also a 15% probability that the returns will be higher, and unfortunately about 15% probability for the returns to be lower than minus 12.4%. So what made this number? Like, what is the intuition, and is it a good number, is it a bad number, should we worry about it? Broadly speaking, there are two main factors that go into this level for the plan. It's the impact of the markets and the impact of the portfolio construction costs. In terms of portfolio construction, the main decision we make is the stock bond split. How much we allocate to equities and how much we allocate to fixed income. Historically, stocks bring the highest chance for returns, but also bring the highest risk, the drawdown. We balance it with the fixed income. So in the column 1, you see what we call the market portfolio. It's a simple blend of 65% MSCI equity, which is the broadest measure of global equities, and 35% of FTSE US Ag, which is the broadest measure of the domestic fixed income. This is the closest we can think of.
I'm sorry, Ed. Can you speak a little bit louder? I can't hear you so well.
Maybe away from the microphone. So this is the broadest, the closest we get to the impact of the market. The second step in the investment process is the asset allocation. This is captured by the policy benchmark in the column 2. In the asset allocation process, we split the equity portion and the fixed income portion into 13 distinct buckets as captured by a policy benchmark. You can see it at the bottom of this page. And finally, in the last stage, we form the portfolio. And this is captured in column 3, and that's where we perform the magic selection, any overweight, underweight, because of the market risk, and also some intermediate cash flows. So let's just take it in steps and see the impact of the market versus the portfolio construction process and affect the risk level. Starting with the market portfolio in column 1, we first review the portfolio construction. It's obviously 65% allocation to equities by construction. There are 3 main factors, 3 main dimensions of risk. That is equity, interest rate, and credit. In terms of interest rate, we measure the exposure by duration. And duration, the easy way to think about it is a scaling factor between interest rate and market value. The duration for the market portfolio was 1.8 years, which means for a 1% increase in interest rates, the portfolio will lose 1.8% in market value. You can see that the duration for the market portfolio declined by about half year, and this is purely because of the rebalancing process in the Barclays app. The last dimension of risk that we're taking is the credit. And the credit is really a measure of ability of the borrowers to repay their debts. The exposure to credit is measured by duration, which is nothing but a scaling factor between credit spreads and market value. The credit spread duration of the portfolio is 1.1 years, meaning that for a 1% increase in credit spreads, the portfolio will lose 1.1%. You can see, first of all, that the credit spread duration is lower than interest rate duration, and that is because a large part of the Barclays app are US Treasuries. Actually, about 60% of Barclays app is government debt, which has no credit exposure. So what does it mean for risk? You can see it at the bottom of this table, and the total risk for the portfolio, for the market portfolio, was 12%. It's about 1% higher than the previous quarter. And that really matches well what Steve just covered before, as the volatility in the markets increased dramatically during this quarter. The VIX, which is a measure of equity risk, is running about twice the level of pre-COVID rates. And in the fixed income, the actions are even more severe. The MOVE index, which is a measure of fixed income volatility, is running almost 3 times the pre-COVID level. It's almost similar to the global financial crisis. So it's not surprising that the market portfolio increased on these levels by 1%. The second measure of risk we present here, which is beta to the S&P 500, is a more of a short-term measure. And what it measures is how much the portfolio will change for 1% drop in the S&P 500. And in this case, you can see that the 1% change in the S&P translates into a 60 basis point change in the portfolio, which is less than the equity allocation. Why is that? And it's simply because of the effect of diversification. As we have a healthy allocation to non-domestic equity markets, and also the fixed income portion of the portfolio absorbs some of the loss. So let's move on to the policy benchmark, which you can see in the column 2. And again, just to remind, this is the effect of the asset allocation decisions. First of all, the equity allocation of the policy benchmark is running slightly higher. It's at 67%. The interest rate duration, which is a measure of interest rate fees, is slightly lower, not significantly, but lower. It's 1.6 versus 1.8. And this is really because we made allocation to high yield, which typically comes at a low rate duration. And finally, the credit spread duration, again, slightly lower, but broadly speaking, in line with the market portfolio, a slight drop because of allocation to the tips. So what does this mean for risk levels? You can see at the bottom of this table that broadly speaking, risk levels are in line with the market portfolio. It's actually a good outcome. As we increase the equity allocation, we expect high risk levels from 65 to 67%. We allocated a lot to more risky assets, such as EM, high yield, and some others. The risk levels remain the same. It's a slight drop from 12 to 11.9%, which is probably not material. And the data is essentially the same as before. And finally, moving on towards your portfolio, which is captured in column 3. The equity level, again, 67.1% is in line with the policy benchmark, and again, by construction, as we keep the portfolio close to its benchmark. The interest rate duration, 1.9, is slightly above the benchmark, and this is really because of allocation to PTI. The core fixed income and public fixed income portion is matched very closely to the benchmark, as you can see on the next slide. And the credit spread duration, again, in line with the benchmark. This is slight overweight, again, because of the PTI allocation. So what does it mean for risk levels? You can see it at the bottom right corner of the table. And you can see that the total risk is slightly higher than the policy benchmark, which is driven almost entirely by our allocation to private markets. Again, we'll see more into details on the next slide. You see that the beta to the S&P, again, is running slightly higher level, again, mostly because of the allocation to the private markets. And we introduce a third risk measure, which I find quite important, active risk. So similar to the total risk measure, and remember, total risk is defined in terms of the expected performance. Active risk is the expected excess return over the next 12 months. So again, next page will show more details and more look through it. We're not there yet, so.
Okay, go back.
Can you bring the previous page, please? Thank you. But again, we see no surprises in broadly speaking. The bottom line is that the risk at the portfolio level are very similar to the benchmark. And again, I see it as a good outcome. And finally, I'd like to draw your attention to these two charts on the right-hand side of the page. Starting with chart 1, which shows you the evolution of the total risk level for the three portfolios for the past 12 months. Two takeaways from this chart. First of all, the relationship between the market portfolio, policy benchmark, and the police funds remains very steady. So what we just discussed for this quarter was a steady relationship for the past 12 months. The second takeaway is you can see that the risks for all these portfolios dipped around end of last year and started going higher. And again, this is driven entirely by the market action. There's no surprise, and we are here at the mercy of the markets. And finally, the active risk, which is the excess returns for the portfolio at the bottom of the page. Again, very similar dependency. You see the active risk bottoming out around end of last year at about 1.7% and taking slightly up to 2% at the end of last quarter, again, driven by the markets. I will pause here with any questions. Now we'll dive into the portfolio.
And I have one question. This is Shuman from Mayor's office. I had one question, which was the beta to the S&P 500. It's quite low. What would you expect the beta to be to the Russell 3000 or the ACWI, which I think is more the market for us? Would you expect that to be closer to 1? Is that a big gap?
The beta to MSCI ACWI will not actually be very much different. We chose S&P as the most important market. If you look across the global equities market, actually the domestic U.S. market govern about 60% of the total market capitalization. And out of all U.S. markets, the S&P is probably the most important. So that's really what drives the domestic equity markets and by extension the global markets around the world. The easiest 0.6, we start with 65% allocation to equities. So you kind of expect it to be in this vicinity. But because of diversification, because of the international markets, and because of fixed income, it ended up being slightly lower. This is actually quite typical for a multi-asset portfolio, so this will be great.
Thank you, Ed.
Okay, so can we go to the next page, please? Okay, so on this page, we dive a little bit more into the portfolio to see the risk allocations at individual asset class levels. Starting with column 1, allocations, you see that the portfolio is managed very close to the policy weights, and that's really our mandate. You see a slight underweight in public equity, public fixed income, and that's to accommodate cash allocations of 1%, and that's outside of the benchmark. But above and beyond, you see that the overweight, underweight are well within their rebalancing range. No big surprises. The only notable observation here is a slight overweight to private equity. It's slightly more than 2% overweight, which is somewhat offset to the underweight to infrastructure of 4 or 5. So at the private markets, we end up being flat. So there's some deviations inside the private. Looking at the risk levels, which is shown in column 2, the several observations stand out. And actually, we refer more to the chart at the bottom. They show the same information in graphical form, which is slightly easier to process. So in this case, the blue bar shows the allocation to the asset class, and the orange bar shows the risk contribution. A few things stand out on this chart. First of all, 2 asset classes punch well above their weight. That's U.S. equities and the private equity. The U.S. equity risk overweight is not surprising. We all know that U.S. equities delivered outstanding performance. It's one of the best performing asset classes globally, which also comes with a higher risk level. Its large extent is given by a large representation of technology in the U.S. market. So it's not surprising that being more volatile, it provides more contribution to risk. The other asset class is private equity, which again, I need to make it before that we model private equity and leverage mid-cap allocation. So again, it's not surprising that elevation risk allocation provides like elevated risk exposure. You also notice that the fixed income allocations have almost no risk contribution. And that's again by construction. It's a good outcome. Core fixed income having a material allocation has almost no risk contribution at the plan level. The same goes for tips. So they provide a useful balance to the portfolio. Above and beyond, there are no big surprises, and the allocations are as expected. And finally, looking at the active risk, which is in column 3, where we measure the deviations from the benchmarks. There are a few notable observations. So as mentioned before, the active risk at the fund level is 2%. You'll notice that at the public equity and public fixed income, there are a fairly low active risk, but there are several areas that stand out. Let's focus on the equity portion of the investment. You notice that U.S. equity is ranked at fairly low active risk at 1.2. And that's really a reflection of a mostly passive nature of investments in U.S. equity. On the other hand, the developed markets as UK come with a fairly high level of active risk, at 3%. And again, this is by construction, as we invest in fairly concentrated portfolios such as Bailey Gifford and others, and I'm sure John will go over this in more detail. On the fixed income side, again, at the public fixed income level, the active risk is fairly low. You may notice that core fixed income comes with a fairly high level of 1.6, and this is really, again, ETI investments that we mentioned before. But find beyond the partly active portion of core fixed income is managed very closely to the benchmark. And finally, on the alternative side, you will notice some big numbers. Again, not surprising. We know that private markets behave very differently from their public benchmarks. So no big surprise here. So how does it connect with performance? Because remember, we defined risk in terms of the expected performance. So that's why it's useful to compare these levels with the returns over the last 12 months. And that's captured in column 4. Steve already mentioned some of it, but one thing that really stands out here is the yield trend on the public side. You see that both equity, public equity, and public fixed income had severe drawdown in the past quarter. And this is again something that Steve mentioned before. The past quarter was an extraordinary period for the 60-40 portfolio, probably the worst quarter in more than 100 years. So it's not surprising that our public markets delivered negative performance. But before and beyond, we see that the performance was in line with our expectations. U.S. equity delivered performance very close to how our risk forecast projected it. Developed market ex-US wasn't stand out, both in terms of absolute and excess returns. And that's again, extraordinary performance, Bailey Gifford and a few other managers. I'll leave for John to go over the details. On the fixed income side, the absolute returns were actually exceeded our risk forecast. That was not surprising given an extraordinary period for the fixed income. Again, much as Steve mentioned, you need to go back to the 18th century to find similar periods for the treasury market. It's not surprising we exceeded our forecast, but the excess returns were well contained and well within expectations. And finally, on the private side, the performance was extraordinarily good. That was the diversified we expected them to deliver. But the performance was well within the expectations and well within our projected performance by our system, with an exception of private real estate, which delivered performance fine above the expectations. I'll pause here. Any questions? Otherwise, we'll dive into the projections. Okay, can we have next slide?
Project away.
Thank you. So the purpose of the next slide is provide a little bit of forward-looking scenarios, like an exercise to see what the future may come. As Steve likes to remind us, almost every day we have no crystal ball. We don't, I wish we had. So it's actually very hard in this environment to select these scenarios. I think we are in a historically most uncertain period, which is unlike anything we've experienced in the past maybe 100 years. So I would say the conviction level is fairly low for these scenarios. That said, let's go over what the future may bring to us. So base case scenario is kind of softish landing, where we expect the Federal Reserve to guide the economy to a mild recession. We expect the inflation to moderate somewhat. It will still be elevated, but will probably come off the recent highs. We expect the equity markets to sell off slightly. We project about a 5% decline. The yield curve will probably steepen slightly. The inflation break-evens will moderate. The credit spreads have further widening, and that's because of the headwinds that corporates will face from the high interest rates, the high funding costs, and the oil price will probably come down. I have again to underscore that our conviction level is fairly low for this base case. It is moderate for the base case.
Can I ask a question? What period of time are we looking at for these projections?
We tend to think about 6 to 12 months,
Okay, thank you.
but it's, and again, it's a little hard to.
Yeah, I just didn't know that this is like a 5-year projection or a 6 to 12 month projection. So that's
I think 5 years become almost impossible to project.
great,
It would
because
take
that is
12
up to
months.
5 years. Yeah, okay.
Yeah.
Thank you.
So the negative surprise is a low level of conviction, but unfortunately this conviction level is growing. And that's where it's the case of hard landing, where the Federal Reserve is tightening in the slow economy, which creates a strong recession environment for us. Inflation is increasing because of the squeeze on the commodity prices, and the credit spreads continue widening. So what may cause this negative surprise? I mentioned obviously the over-tightening by the Federal Reserve, but also there are several geopolitical reasons that they create positive scenarios, such as unfortunate surprise from the ongoing war between Russia and Ukraine, the impact on the European market, especially Germany, but also ongoing challenges in China as the Chinese economy is restructuring and going through a period of softness. And finally, this room for a positive surprise, which again we see as increasingly remote possibility, but not impossible. We may see a successful resolution of the war between Russia and Ukraine, but I think the biggest chance for a positive surprise comes really from the fiscal policy, be it in Europe or in China or potentially domestically. So in case of positive surprise, markets will rally almost across the board. The yield curve will steepen, funds will coming down slightly, the beta will move higher. The inflation will moderate significantly, commodity prices will decline, and the spreads will tighten. So what does it mean for the portfolio? There's several interesting observations from this. So let's start with the base case. You can see the results at the portfolio level at the bottom chart on the left, and the breakdown for individual asset classes on the chart on the right. So on the base case scenario, for minus 5% decline in equity prices, the portfolio will deliver a minus 4.1% decline. So that's a somewhat unfortunate outcome, as we capture probably more of the downside than we expect. Almost 80% of the S&P decline is captured in the portfolio. So why that is so? Take a look at the chart on the right. We're focusing on the gray bars, the base case scenario. You'll notice that every single asset class is declining. We really need to know diversification under this scenario. The equity sell-off is expected, but also the fixed income, the TIPS and the core fixed income is declining. High yield is selling off. Private equity is selling off. We really need to know diversification here, and that's here what captures the downside. In terms of positive surprise, the outcome is also less than ideal. On the positive surprise, we project a plus 10% rally in the equity market, yet the portfolio delivers less than half of that. Why that is so? It's is allocation of the tips. That's what drives the portfolio down. Core fixed income again delivers a negative outcome, and notice that core fixed income is actually negative under any of these three scenarios, which is somewhat unfortunate outcome. And finally, the negative surprise. Under the negative surprise, the portfolio performs probably somewhat as expected, more in line with the 60-40, 65-35 breakdown. We deliver a minus 9.4% downside. These some diversification from the tips, but notice the private equity allocation. Private equity delivers probably more surprise than you would expect. Again, I have to caution that our risk modeling of private assets is probably less certain than public, so they will be unsolved. Yet I think these scenarios tell an interesting story. And again, you can underscore that our crystal ball is broken, if it ever was. And given how uncertain the current environment is, teaching just three scenarios out of millions of possibilities doesn't do justice to the potential outcomes. So I will pause there in case there are any questions.
Question.
Well, let me ask you something. I'm not a statistician. I dabbled in it for one semester. So I'll just put this. How far off can these projections be within the margin of error?
I would hesitate to assign margin of error. So if you notice at the top of this page, we take 5 asset classes.
Thanks.
We try to project this chart based on the historical scenarios. As I mentioned before, the current environment is here without precedent. There's a strong discussion among the economists, what is the closest historical environment to today? And probably, I would say there's no consensus. The best estimate I've seen is 1918, which is a post-First World War, post-Spanish flu environment, which performs somewhat similar to the current market. Clearly, the economy changed dramatically since then. The economy, the market, the global environment, and that's why I said before the conviction level is low. I would hesitate to put any statistical estimates. Statistics implies predictability. We're not there. I can easily draw hundreds of other scenarios. But the interesting takeaway is that we do not see much of downside protection from these scenarios.
From this what?
From these scenarios,
Okay.
highlight the downside protection will not always work. So there is some degree of downside protection in the portfolio through private assets, through manager selection, through the 65-35 construction. But clearly, it's mostly long-only portfolio, and we're subject to the market protection.
Which is where we're designed to be. We are designed for that.
It's back to the long-term nature.
Long term, back to the basics.
Exactly.
Were these projections put together after Powell's speech or before Powell's speech?
Before.
So we may have already hit the red.
Yeah.
Well, you can also say whether 5% is within almost daily fluctuation. So yeah, it's very hard to make any projections in this environment, unfortunately.
I'm not a philosopher, although I dabbled in it one semester. But,
You could have been on Saturday morning between 9 and 12 for me, over in Baruch.
but, we can all guess at where the market's headed, who knows, right? I think this was very helpful in trying to understand the broader portfolio and what our goals are here and what we're trying to accomplish.
I think, look, I'm a child of, obviously, growing up in the city. I wasn't, following markets, but I remember trends and I remember things growing up. And the 70s were hard, high inflation. The 80s, where Greenspan jumped in and put the brakes on things. And I remember going into a bank and getting 13% on my account, when I opened it up. Trends tend to come back and forth, and this is a bad trend. Worldwide inflationary pressure, a lot of things that are going on. Gee, funny. I thought we would come out of the Cold War and Russia was our friend. Now they're not our friend. China's looking, they're knocking on the door on the other side. And we've got enemies who are financially problematic too. That worldwide market now also brought new problems. So yeah, there's a lot of uncertainty where we thought there wouldn't be as much uncertainty as we thought there would be, but now it is. So.
Well, now that you've explained how old you are,
Hey, I don't lie. I'm old enough. I remember Brioschi commercials. Remember that? So,
I don't know if you remember the proclamation that you entered on his 50th birthday.
I actually do. I actually do remember presenting him with a proclamation. Yeah. We had a lot of resume paper in the control office that year. So,
Two questions, if I can ask them.
Sure.
And just a comment. Ed, just on this slide, would you venture to put probabilities on these scenarios, a negative, positive?
Again, I would hesitate to put probabilities. Again, I would underscore that our conviction level is fairly low. And if anything, we
Sorry,
believe
I can't
that
hear you. Chatter or something. I can't hear you clearly. I'm sorry.
it's hard to hear you.
Yeah,
That's what he's saying.
There's chatter.
They're up there.
Okay, yeah, between the microphone. I would say that conviction level is fairly low, given how unique this environment is. And if anything, we believe that the negative surprise is getting more likely by the week. But we can probably easily draw hundreds of other scenarios. And it's very hard to limit our universe just to see possible outcomes. Unfortunately, the world is very uncertain at this point.
I just had one other question on
To
the
your
slide.
point earlier, it's not without precedent. I'll tell you what else we know. We've
I
seen
had a
something-
question on the slide before. Just a quick one, just a factual question. Were these over and underweights? These don't include placeholders, right? If these are overweight, underweight, are they a result of placeholders or they're independent of, you've subtracted out the placeholders?
Even parking place for private assets.
Yeah, so in this column where it says US equity, overweight, underweight, 0%, and 30 is our policy. And is that the actual right now? 30%?
These are the actual weights, yes. And
So
the other.
it would include the placeholders.
So Shuman, when we, this is Dan, when we put these together, these are our policy targets that are not adjusted for parking places. And we can contrast that to the active weights that Steve shared with us a few minutes ago, which have been. So there's a slight disconnect there. The goal here, Ed, correct me if I'm wrong, we wanted to show active weights here relative to our long-term targets. So we're taking kind of a longer view in constructing this.
I just want to clarify, I wasn't a criticism, that's great, this is great. And this is my overall comment, I just, thank you for a great presentation and for a meaningful risk.
Sorry, Shuman, I can't hear. I don't know if anybody else
Losing
is from,
you.
but I couldn't
Yeah,
hear.
I just want to really thank Steve and Ed for the presentation. It was very meaningful. And Ed, the risk report was very meaningful, and your explanations and walking us through the discussion was excellent. So I just wanted to thank you for that. Both of you.
Thank you.
I guess I'm glad I hear yourself.
Yeah, there you go. So if the risk presentation has concluded, we have one more item in the public session. We're going to turn it over to Kate Visconti.
I think I'm gonna turn it over to
And
me.
actually, I'm going to turn it over to Allison before we turn it over to Kate. So,
Sure. So, one of the issues that came up repeatedly, I think when Brad took office and I joined the team, was a general lack of transparency coming out of BAM and an inability to really understand a lot of the reports and the information that comes to the trustees and to the general public. I, for one, can't read like the monthly reports we get from State Street that get uploaded to Convene that are public. I don't understand them. I changed my major my freshman year of college because I hated statistics so much. So,
I had to take it for my major, so. that was-
yeah, no, I literally shifted from urban studies to religion so that I would not have to take statistics anymore. But I'm learning now. But anyway, so one of the projects that we've taken on that has really been led by Kate Visconti, who is our Associate Director for Pensions and came in about a month after I came in February, was to create a user-friendly, transparent way for trustees, for beneficiaries, for the general public to actually understand the public information about our investments and our funds. So after this round of September board meetings, we are going to be launching a change in the controller's website so that folks can probably see where our money is invested. And so we wanted Kate to walk everyone through what the new website will look like, ask any questions, give any feedback, etc. So I'm going to hand it over to Kate and just want to thank the tech team in the controller's office for working with Kate and everyone for pulling this site together.
They may have had to take a statistics class, so.
Definitely. Okay, thanks, Allison, and trustees, thank you for your time on this. I'm going to take a quick 5 minutes to give you a quick overview of the tool and walk you through a couple examples of how we think you might want to use it. So as we get started, just keep in mind that all of the data presented here was already available to you in your monthly and quarterly reports. And it's already linked on the website in PDF form, but as Allison said, this is intended to make it a lot more user-friendly. So this here is your asset under management, your net asset value dashboard. So looking at this as it is, you're seeing all 5 systems. Let's drill into yours. Okay, now what you're looking at is data for your system specifically. So over here in the top left corner, you can see the 47 billion total net asset value. Over here on the right, you're seeing that same total net asset value, but it's broken down by asset class. So you can see, for example, public equity, you have 20 billion, its unit is in millions, so 20 billion. Down here in the bottom corner, you're seeing that same information broken down by asset class, but presented visually. So you can see quite clearly how the different sizes of your different asset class portfolios compare to one another. Now, in the bottom right corner, you're seeing what we think is probably going to be maybe the most useful addition here. So this lists all of your investments with the corresponding net asset value for that investment. So with that, I'm going to walk you through some examples. So let's say you want to see all of the investments that you have in private equity. You could go up here, these are filters up here, and you could select specifically private equity. And now you're seeing the dashboard shift, you're seeing private equity. So you're seeing over here in the top left corner, 4.79 billion. That's the total private equity that you, portfolio size that you have. And then down here, you're seeing again, all of the investments that you have in private equity and their corresponding net asset value. So for example, EQT Fund 8, you're seeing that you have $103 million in net asset value. So let's say that you wanted to see all of your investments with EQT and you know that you have investments both in private equity and in other asset classes. So you're interested in all of that. You could go ahead and clear the asset class filter, go over here to investment name, type EQT. And then as you select all of these here, you're going to start to see all of the investments that you have with EQT across asset classes. So now you're seeing everything EQT. Over here, you're seeing the total net asset value for EQT. You're seeing it broken down here by asset class. So you're seeing infrastructure, private equity. Down here is that same information visually. You're seeing that you have maybe double the amount of money in private equity with EQT versus infrastructure with EQT. And over here, you're seeing all of the investments themselves. And you're seeing the corresponding asset class, corresponding net asset value. So let's say that it was maybe a member who needed this information or something, and you wanted to export it and send it to them. You can do that, just clicking here, download it. It comes down as an Excel spreadsheet, and you can use that however you might need to use it. So that is your assets under management tool, your net asset value tool. We also have a side of this that deals with asset performance. So looking over here in the top left corner, you have fiscal year to date performance. So let's say you're looking April. So this is your fiscal year, your fiscal year to date for the end of April for your system over here in the top left. Looking at the top right and sort of below, you're seeing your total performance for each given year. For right now, you're looking at for sort of your entire portfolio across asset class. You're seeing the data here. You're seeing it also down here presented in bar chart form. But let's say you were interested in seeing this data for infrastructure. You could go ahead and filter it. And then again, it'll shift a little bit. And now you're seeing your returns in infrastructure across these different years. And you're seeing them down here in the blue chart visually.
I had a question, Kate, on this.
Yeah.
It's okay if I disturb.
Yeah, please. I was just going to open it up.
Yeah, when you put April 2002 for fiscal year across these different fiscal years, are you seeing as of April 2002? So is it what it compares it across the years?
No, that's a great question. No. So this chart here is the one that's fiscal year to date, and it's limited to over here. And then over here is basically across all of the fiscal years as of fiscal year end. So June 30th.
Oh, got it. So it's all past complete fiscal years over there.
Mm-hmm. Yep. And we'll have 22 added soon once basically all of the systems, once you all receive that data in your meetings this month, it'll be added here as well.
Interruption.
Kate, I have a question.
Yeah.
And Stephanie, I can't see the small print, so my question is, for example, I can't really see it. So say 2 months ago, the board approved a $100 million investment. If we were to look that up, would we see how much money is actually invested and in what? Or would it, I mean, I know we've approved $100 million, but where is that money? Will one of these charts show that?
That's if it's
Can I?
Yeah, go ahead.
So at the moment, nothing will be in this chart until the contract is inked.
Right.
And cash and money goes to the manager. So 2 months ago, we approved a $100 million investment. Given our procurement process, in all likelihood, that contract will not have been signed yet, and it will show up in this chart once there is a net asset value of that within that fund, and they call capital. Over time, this is step one. At some point, we would like to be able to say publicly, this quarter, we signed these 5 contracts or whatever. We executed these 5 contracts based on past votes. That is sort of a next step in what we want to publicize.
But still, my understanding is that not all the money is necessarily invested on day one that the contract is signed. So will we know as money is invested?
This is updated monthly, so you'll see if you want to see as money comes, as money is called in. You'll see in March we had 25 million, and in June it's 50 million now.
Okay.
Just know that for private equity, for example, we give 100 million to someone, they may only draw down 50 or 60 million.
Right, and that's what I want to know.
Right, and then as time goes on, they may make calls.
No, I understand that, but will that be shown here so that if I'm looking at investment ABC that we signed a year ago, and it says $100 million, but will it say that we have already invested 75 million of that and 25 is still?
Do we want to get that?
Well, I don't know.
Okay, everyone, hold on.
Okay, so I just want to remind folks that this is not replacing the quarterlies that do exist. So for those people that want to go down another level and look at an individual manager's performance over time, the quarterlies are still on the controls website in the pension library. This is really the information we get asked the most from people, is what our exposure is to a manager. If there's other questions stemming from that, there are other avenues that folks can go to kind of
go down and look at the longer term, how much capital is drawn, what the IRRs are. But this is really a tool that answers 95% of the questions that we get about what goes on in the portfolio on a day-to-day basis. There are always going to be there's always going to be something that somebody's going to need a little bit more information on. The quarterlies still do exist. They get produced, they get sent to the manager.
Can I jump in here? Also, there's a way, if you want to see how our money in BlackRock has shifted over time, you can go to as of, right? You can't do it in one search, but you can do multiple. You could go to as of, Kate. You can look at, March 2022 and compare it to April 2022 and May 2022, right? Like, there is a way to use this tool to look at an investment in a specific asset manager over time. You can't do it all on one screen.
And this is very good, and I like the layout, and it's very easy to follow. My only concern about this, and again, as trustees, we sit here, we absorb a lot of information from very wise people, and whatever we bring to the table, but we are surrounded by sharp people, and we make decisions based on that information. This doesn't reflect that per se. And so when you mentioned right now, this is the stuff you get most asked about. My first question, and it's the cop in me, who's asking this question? And I would say it is essentially, we'll get to groups that will target certain investments. We're not sitting at the table. And then we'll essentially, we've seen it before, sitting at the table, a campaign to try to divest, to try to target a particular asset class. That's my concern. And I always tell people, I don't invest the way I'd like the world to be. I invest the way the world is. And I get worried about that when I hear this type of granularity. While good and necessary for some people, it can be abused. And I just bring that in as a caveat.
I hear that. I want to say two things. There is nothing on this website that is not currently on the public site, right? So it's about, and so those advocates, those folks that you're talking about, they find this information, but they just have to go through the annoying PDF. And now I guess we're making it easier for them so they don't have to go through the annoying PDF. I think 9 times out of 10, the questions we're getting actually, whether it's on this fund or others, are from trustees who can't figure out, who are like trying to pour through the monthly reports and actually can't figure out what it's telling them.
And that goes back to the history that I know I've asked for and others have asked, that we need something for the trustees, make it more specific to the trustees. This is a nice step in a direction where I think we could have something a little bit more meaningful to the trustees, where they can actually just pull it up on their phone or on their iPad or whatever tablet that they're using, and they can dig out the information that they need, whether it's current or whether it's 5 or 10 years in the past, and look at. So I think trustees need as much information as possible. And so while I'm on that subject, I just want to mention, looking on Convene, I find the minutes are incomplete only because I only have the first page of minutes going back months, and I looked and it's like a whole year, just the first page.
Just the first page.
Just not all the minutes are involved. So
that we can fix.
Yeah, and I bring it up only because now this tickling that file in my head. So
we'll double check that.
All right, thanks.
Maybe we just did it to yours. I'll check.
It could be. Listen, I get targeted all the time.
And that should be.
Yeah. All right. But this is very good work, and I appreciate all the hard work and the sentiment that you're listening to the trustees and others.
Thank you, Kate.
Yeah, thank you, trustees, for your time. We hope it's helpful. It's it's your data, so your feedback is critical. Any questions or additional feedback you have, send them our way.
If I can just make one comment, as the new CIO, I've been using this every day. It's been very, very helpful. I find it just chock full of good information. I actually thought the old website was good. This is really.
Yeah, it looks like it's good.
So with that, I believe our public agenda is concluded,
So I make a motion to go into executive session.
and I'll second your motion to go into.
And now we're gonna go
Well,
into,
let's wait until we can.
You guys are on mute.
Oh, there you go.
I'm not doing this
Wait,
anymore.
did you get the vote,
Did you get the vote?
Rafa?
When you went into public, I didn't get anything.
Okay.
Are we recording?
Honestly,
Yeah.
let's go.
Yeah, there we go.
Yeah,
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 Listen.
Yeah, well, you'll wait. During the executive session, the trustees heard from their consultants, BAM, and several managers regarding infrastructure. Decisions were made. Those decisions will be made public at the appropriate time.
Motion to adjourn.
second.
We stand adjourned.